So this just happened December 1st. Officially, the Federal Reserve has ended quantitative tightening. Quantitative tightening is a term for essentially the Federal Reserve allowing the assets that they hold on their balance sheet to roll over and to not re-up them. So they hold mortgage-backed securities, they hold treasury bonds, these kind of things. When those reach expiry, they're not buying new ones. They're not printing money to buy new assets in the marketplace and to affect interest rates or to basically manipulate this free market that we have here. We can actually take a look at this chart here and we can see the total assets on the balance sheet of the Federal Reserve here. And you can see here in 2020, it massively spiked up and had this gradual incline after that. So here in 2022 is when the balance sheet started to actually tighten instead of ease. So all of this is money printing. All of this uptrend in this balance sheet is the Fed taking capital, taking cash, injecting it into the economy to buy assets that are likely distressed or likely have term duration risk that isn't able to be handled by the private sector. So right here, this is actually, I'd have to fact checked completely, but I'm guessing that this is Silicon Valley Bank right here in 2023. So they did the term funding program and bought a bunch of toxic debt for the private sector that took on too much risk and effectively did not manage duration properly. And then it began tightening again. So we've reached this level here of sometime just again here in 2020. The balance sheet is $6.5 trillion on the Federal Reserve. This is what is being told to us. And what we can see now is with quantitative tightening stopping, we can likely see some sort of stagnation here where they're taking in, they're buying as many assets as they're allowing to expire as well. So that means that their balance sheet is even at this level. So we could see a period of time where this isn't going up or isn't going down. So this is looking at 2008 here. We can see it's just sort of just gradually going up. And then all of a sudden there's a catastrophe that they're stepping into the market and trying to, manipulate. Basically, they're not allowing a recession to happen just naturally. They're stepping into the market, bailing out banks, buying all sorts of garbage and injecting printed money into the economy, which leads to inflation and all sorts of manipulation of prices and whatnot. So that happened there. And you can see it's just kind of gradually, this is them sort of saying, hey, we're keeping an even balance sheet. It's just gradually going up until the next problem happens and the next problem. And you can see here, this is the most stable that they've been able to be. And they had actually a decline here, which is possible that this led to a tightening of liquidity in the market, which could have made something like the event that happened in 2020 potentially more effective at causing a disruption, which would allow them to inject a lot of liquidity. They're always looking for reasons to print money. That's what I believe, and they never let a catastrophe go to waste. So if there is a problem in the market, essentially what I'm saying here is this could trade sideways for a bit. Their balance sheet could stay relatively steady. Maybe it'll start to incline slightly, but if something cracks in the market, they will step in like they did here, like they did here, like they did here. Right? So they will step into the market. They will be the biggest buyer. And what this does largely is this affects the long end of the curve more than interest rates and the sort of the Fed funds rate that we talk about a lot with the FOMC meetings and what the overnight lending rate is. That affects short-term duration debt. And this, the quantitative tightening, the balance sheet of the Fed, this affects the long duration of the yield curve a lot more, which is what mortgages are built on. Treasury bonds that are issued by the US government, say the 10 years and longer duration than that. This affects that a lot more than the interest rates, which affect the short term.